Is the screen visible? Is the screen visible?
It's still blank.
It's still blank. Okay. Now?
No, ma'am, not yet.
Okay. Okay. Now, I think it is now visible.
Yes, ma'am.
Yes, ma'am.
Okay. So, in our last 3 sessions, we have discussed the theories and then how those indicators may be used to, that's the logic behind using the indicators for um, assessing the financial health of a firm. So we shall be starting with this undertone. So when we watch a tennis match, we just move our head from left to right, and when you are watching the stock market, then the prices are either high or they are low. So you will have to keep a continuous watch on that. Now, before we start on, I'll try to share a very small video with you. And if it is possible, I'll be sharing another video with you when I'll be ending the session. So let's see. Is the video visible?
No, ma'am.
No. Okay. Now,
Ma'am, the Google Meet screen is visible right now.
the Google Meet screen is there. Okay. Now,
Yes,
Yes,
ma'am,
ma'am.
it's starting.
okay.
Yes,
Okay.
ma'am.
Okay. Okay. So that is the basic idea that I'm trying to convey. So whenever you are talking about the return, there will be the hidden risk. And so you should be able to identify the risk associated with the investment or risk associated with the decision. Now, if you just fail to do that, then what happens? I'll perhaps share another video with you when I'll be ending with the session. So now I'll be going to the data that I have already sent to all of you. Now, just let me know whether it is visible or not. I'm just trying to present it. Is it visible to all of you?
Yes, sir.
Yes, ma'am.
Okay, fine. So this is the data that I have shared with you. So this is a part of my data set actually. So I have shared with you the data on balance sheet and profit and loss account for the Maruti Suzuki. This data has been collected from a free website which is moneycontrol.com. Moneycontrol.com. So this is authentic data, so you can always use this. But here I have downloaded only data for 5 years for the balance sheet and the profit and loss account. But if you go to the financial ratio, then it will be then you can easily find that data is available from March 2004. Therefore, we have data for all these periods. So that is quite a long period of time. But of course, that is not sufficient for any time series analysis. So I'll be discussing that, but we shall be using these financial ratios, and we may use also these data or some of these data in order to comment on the potential of the firm. So as you see here, this is the balance sheet. So first the equity and the liability side is presented. So you have the data in the form of a column. So first the equity and liability side and then the asset side. So as far as the financial economists are concerned, it doesn't matter which elements are described first and which comes later. So what we are interested in, the asset and the equity and liability side and the different values. And then if you can find here, you can find almost all the definitions that we have discussed in the three other sessions. And similarly for the profit and loss account, so the income and then all the expenses, then the dividend and the profit. Okay. Now, so when we are starting evaluating the potential of a firm, we shall be talking in terms of these financial ratios as well as the prices of the firm. So apart from this moneycontrol.com index, you can always go for this database, Prowess, which is sold exclusively by CMIE. So that is a paid database. The institution can purchase the database, or individually the researchers can also purchase that. But it is a slightly highly priced data. And there are certain problems with Prowess also. In some cases, you have missing data. In some cases, often the papers based on the Prowess database are not considered that reliable in certain journals. So you should be very careful while you are choosing the data. You can go for the Bloomberg website also. So there are different ways of collecting the data. Now, along with this data, we shall be considering the data on the prices, the price data. So the price data has been collected from bseindia.com. So this is the official website of the Bombay Stock Exchange. The name is still Bombay Stock Exchange. It is not Mumbai Stock Exchange. So this is the official website of the bseindia.com. So if you go there, then you can find the data for different frequencies. You can have the daily data, you can have monthly data, or even you can have the annual data. So I have collected the annual data also as well as the daily data. So first of all, we shall try to find out whether you can term this stock of Maruti Suzuki as a growth stock or not? Or could you consider it as a cyclical stock? So whether the movement in the prices of this particular sector or the particular company's price will be in line with the cycle of the economy. So for that, let us consider whether we have the data here. No, I don't have the data here. Okay. So here, see, I'll just show you how to do it. So that is why I'm deleting all these things. So we have data on GDP per capita, and so this is not actually in current US dollar. This is in terms of rupee, and it has been taken from the RBI website. So the GDP data has been taken from the RBI website. So we have data from 2004-5 to 2019-20. So we have considered the stock price of the Maruti also. So that is the annual price collected from the BSE Sensex. Now, one major problem associated with the financial ratio analysis is that we have only a limited number of observations. So either you are working with the annual data. So here we are considering quite a large number of time from 2004 to 2020, but you have only this much data point. You have only 16 data points, right? Now, 16 data point is not at all sufficient for any time series analysis. Therefore, if you run a regression analysis, taking the prices on one hand and all the other fundamental variables on the other, and you say that your R square is very high, the coefficients are very significant, then possibly you will be misguided, because it is not advisable to depend so much on such a small data set. So either you go for a quarterly data, or you can go for a panel data analysis where you will be having many cross sections as well as many time series. Now I'll be just giving you the idea about the panel analysis, because if you don't know, I just don't know whether you are familiar with all of you are familiar with the theory or not. So in that case, it would be difficult for me to show you anything anything rigorous on the panel data application. So I'll be giving you the idea. Okay, so here we have considered the annual price of the Maruti Suzuki. Now, as you can find out, if we are talking about the annual prices in the stock market, then we are losing all sorts of information, because as I have mentioned in some of my earlier sessions that what we are really interested in is the fluctuation and not in the some smooth or in some filtered series. So that is why annual data or monthly data will suppress most of the information that we are trying to depend on. Okay, but here, since you are trying to relate it to the GDP, there is no other alternative. So the first line of analysis may be the simplest possible thing. You can just plot these two things. Now, of course, so yes, okay. So you have the GDP line and the stock price. Okay. Now, just by looking at this, can you say anything about the cyclical nature of the Maruti stock? So for that, we need to have some more information, right? So for that, now, let us first of all consider, now see, these GDP values are too high and the stock price values are too low. So therefore, if you want to compare these two things, then it's better to So it is better to consider the log of GDP and log of the stock price. So in that case, your values will be a bit downward revised. So equal to okay, so that's the series. So now we shall try to isolate the cycle from these two series, and then we shall be trying to compare these two. Now, what is a cycle? If you consider any kind of time series data, then there are four components actually embedded in that. What are those things? As you all know, you first have trend, then you have cyclical fluctuations, the seasonal fluctuation, and the irregular components. So when we talk about the cyclical fluctuations of the cycle, we shall be removing the trend from this series, and it's an annual data. Therefore, there is no need to compensate. There is no need to filter for the seasonal variation. Therefore, you just can remove the trend and you can isolate the cycle. Now, there are two ways of finding out the cycle. For the annual or the macroeconomic data, you can go for the Hodrick-Prescott filter, or you can go for a frequency bandpass filter. Now, for the Hodrick-Prescott filter, we can always isolate the cycle in the series, and that is available as, or the computation method is available as an add-in in the Excel also. So in Google, you just give a search for HP filter, Hodrick-Prescott filter. So you just give a search for HP filter in Excel as add-in, and you will be getting a link from where you can get the HP filter as an add-in. Or alternatively, you can go to the eViews or use eViews in order to find out the Hodrick-Prescott filter. So here I'll be using the eViews in order to show you. Okay, tell me, is this portion visible? Is eViews portion visible?
No, ma'am.
No, okay, okay. Now?
Yes, ma'am.
Okay, okay, fine. Okay, so let us start from the very first thing. So this is the eViews 10, but frequency band filter is available in eViews 7 also. So there is no harm if you have eViews 7 or eViews 8. So you can always do that. Okay, so here we are introducing a new work file. It's a dated file and the frequency is annual. So our starting date is 2004 and the end date is 2020. So we have only this much of observation, 17 observation, which is actually nothing so far as the time series is concerned. Now we shall be, I'll be just copying and pasting the series from Excel. Empty group, edit series, and then you just paste the two values. The point is that here you have, okay, so actually we have 16 years of data and I'll have to modify it a bit. So the data should be from 2005 because the financial year is 2004-5. So the data should be from 2005 to 2020. Okay, so that's my data set, but you don't have the name, series name, so you will have to give that. So my first one is the GDP. I'm making the change here. GDP, it is a log GDP. Yes, and this is the Maruti stock. Now we will try to, so just close this. So now we shall be moving on to the frequency bandpass filter. Now the frequency bandpass filter is nothing but a technique to isolate the cycle from the time series. So in our college days, actually, we eliminated the trend from the series. You can have moving average and other similar techniques. So the frequency bandpass filter will be a similar technique based on the moving average, where you will have to specify the leads and the lags, right? But there are different alternative ways to calculate the frequency bandpass filter, which can make our life relatively simple. So that instead of fixing just the leads and the lags, we shall have to have only the full sample data, and on the basis of that, we can find out the cycle. But before we move on to that, we shall have to check for the stationarity of the series, that is required. Okay. So before we move on to that, we have a GDP series. Now, once again, I am saying that it's a very, very small observation or a very small data set. So the result may not be that reliable. Okay, so I'm going for the simple unit root test. You can have a breakpoint unit root test also, where the system can endogenously identify one breakpoint. So that is the problem. You can identify only one breakpoint here. If you are trying to find out more than one breakpoints, then you will have to consider some other models. There are other switching regression models available. For example, you may have the Markov switching or the threshold regression models that can be also used here. But here we are not going into the breakpoint unit root test because of obvious reason. There is only 16 data points, so I'm not going into that. So I'm just going for the unit root test. And in level, okay. So the null hypothesis says that GDP has a unit root, and this is the augmented Dickey-Fuller test statistic with the probability. Now, somebody please tell me whether GDP has a unit root or not. Who is going to answer? Who is going to answer?
No, ma'am,
It
it
seems
doesn't
that
contain a unit root.
it seems that it does not have any unit root
Okay. How do you conclude that?
because the probability is less than 0.05.
Probability is very low, and this is the probability of accepting the null. Okay, very good. So that's right. So GDP is actually I0 or I1. GDP is I0 or I1, integrated of order 0 or integrated of order 1. If it is stationary,
I0.
I0. Okay, so GDP is I0. Now just go to the other one. GDP is I0, but prices actually will never be I0. See, prices will be I1 always. So that is why we work with the return series, right? So we work with the return series for two reasons. Number one is for just the methodological purposes, you make it stationary. And the second one is that since we are interested in financial investment, now the investors will be interested not in absolute prices but in changes, right? So returns will be more important, or returns will be more relevant for the investor. Therefore, instead of working with the actual price or the actual variables, we consider the proportionate changes, right? So Maruti is I1. So let us now try to identify the cycle. So we are going to PROC. So here you have the Hodrick-Prescott filter, but I am not going into that because there are certain problems associated with the Hodrick-Prescott filter. But of course, these two filters will be giving you the same result so far as this data set is concerned. I have checked that. You can also check that. So this is the frequency band pass filter. So as I have shown you, or as I have mentioned, there are different ways of isolating the cycle. So either you fix the lead lag relationship when you are doing the moving average or the lead lag numbers. But if you talk about the full sample asymmetric method, which was introduced by Cristiano and Fitzgerald, you need not specify the leads and the lags. So, but you will have to specify the stationarity assumption. So what is our stationarity assumption? This is for GDP. So GDP is stationary, and we are trying to detrend it because we are interested in the cycle only. So we shall be detrending it. So we shall be removing any linear trend, right? So we are removing the linear trend. Now, if there is a non-linear trend, then we are not removing that. Okay. So I'll be coming back to another thing also. Okay. So that is the removing the linear trend. So it will be giving us the cycle series as well as the non-cyclical series. The cycle series is automatically given the name BP filter 01. But in order to isolate or rather in order to recognize it quickly, let us give it a name which is cycle underscore GDP. Now, what are the cycle periods? This is an annual data. Usually, we assume that the business cycle lasts for 2 to 8 years, right? So this is the minimum number of years and that is the maximum number of years, 2 to 8. So since you have given the first information as annual data set, eViews has already taken this as default. So if you change your data set from annual to monthly, these values will be changing, and if you are going for the daily data set, then that will be becoming 560 and the high will be becoming 2880. You will not be multiplying by 365, rather by 252 the number of trading days, right? So that is the either you just save your data set as unstructured data. In that case, you will have to put these values on your own, or if you save it as a structured data set either annually or monthly or quarterly, then the eViews will automatically taking up these values. Okay, so this is, and we are not interested in the non-cyclical series. If you are, of course, if you are interested in the filtered series, then just give one name for that, because otherwise the blank fields will not be generated. So here we are interested only in the cycle, so that is why I am taking the cycle here. If you are interested in the non-cyclical series also, then you can give certain name here, say non-cyclical GDP, and you will be getting the okay, I'm showing you. So non-cyclical GDP. So in that case, that will also be generated. So okay. Oh, the name is, it is not taking that name. Okay. So that is cycle GDP, and say GDP filtered. I think that name will be okay. So that is the original line, non-cyclical line, and this is the cycle. That gives you the cycle in GDP. So we shall be saving it here, and then we shall try to relate the cycle of GDP with the cycle of Maruti. Okay. So close this. Go to Maruti. Now I am not describing the cycle Maruti, and that is I1. So be clear about all these things and be very careful about this stationarity assumption. Okay, so that is the cycle of the Maruti stock. So what shall we do now? Now you can plot these two series. I'll not be plotting these two series in eViews. Rather, I will plot these two series in Excel. Yes, do you have any question? No. Is it visible? Is the Excel sheet visible?
Yes, ma'am.
Okay, okay. Okay, so we have the cycle GDP and cycle Maruti. Copy the date here. Right, so now we shall be plotting the cycles. That's once again the same problem. So data series, show it on the secondary axis. Okay. So now you have cycle GDP as well as cycle Maruti. Now, is it a cyclical stock? Is it a cyclical stock? The cycles are given. What do you feel? Just by looking at the graph, what do you feel? Who is going to answer? Don't write it. It is cyclical. How do you feel that it is cyclical? Just tell me.
Both the cycles are similar in pattern.
Right, they're similar in pattern. So when the now you just cannot say that this one is higher than this because we have two different axes to represent the two series, right? So we just can compare the movement. So when the GDP cycle is upward moving, then the Maruti cycle is also upward moving. So in that way, these two movements are closely interconnected, right? So it may be treated as a cyclical stock, but to be very sure, you shall have to consider the sustainable growth rates and the other growth rates of the farm. Now, so just by you can have another way of looking at the relationship. That is a very naive way actually. You can simply rely on the correlation coefficient between these two original figures. Now, whenever you are talking in terms of the correlation coefficient in this particular type of data set, you consider two types of correlation. First, you check whether X in period T, suppose you have two variables, X and Y. So whether XT and YT, these two are correlated. Okay, that is the first thing that you will be considering. And then you may consider it in a bit different way. For example, say GDP and stock, there is a lead lag relationship. So GDP first moves and then it is followed by the Maruti stock, right? So here we are assuming that we are trying to make the stock dependent on the movement in GDP. Therefore, we shall try to find out if GDP increases in the Tth period, what happens to the Maruti in the T plus 1th period. Therefore, now our correlation changes. So XT with Y T plus 1, right? So if GDP increases in 2005, what happens to Maruti in 2006? But as I am pointing out, or rather as I am emphasizing always, that the annual data will be suppressing many information. Therefore, you may not get the actual result on the basis of this annual data set. So I'll always suggest you to go for a quarterly data set if possible. Otherwise, it will be very, very difficult to come to a conclusion. Okay, so here, let us first of all consider the correlation between GDP and Maruti for the same period. So let us consider, okay, I'll not be using this. So go to data analysis, and there you go to correlation. Or you can go directly also. So just input range. Here we are considering the log GDP and log Maruti, but you can consider GDP and Maruti also, that there is no harm in that. So grouped by column, and you have labels in the first row. So the names are there in the first row, and you just specify the output range. Specify the output range. Okay. So the log GDP and log Maruti, the correlation coefficient stands at 0.93. Now, as you all know, that correlation coefficient does not give you the movement or rather the direction of the movement. So the lead lag relationship is not there. But of course, you cannot do anything, any lead lag relationship or like that using this type of analysis. So you can go for panel bar or anything like that. But once again, that may be subject of another full workshop. So GDP in period T and Maruti stock price in period T, these two are correlated, and the correlation is significantly high. Okay, I'll not be saying significantly high. It is high because I have not tested for significance. So whenever you will be using these words, be very, very cautious about using. If you have not tested for significance, do not call it significantly positive. Okay. So now we shall be going for the correlation between GDP in period T and Maruti in period T plus 1. So you can make the data set on your own also. So in that case, I'll be showing you how to do it. So here. Okay, so GDP in 2004-5, so that will be associated with stock price of Maruti in the next period. Okay, so I have taken the actual values. It's better to take these two values. So once you are done with any formula, always copy it and paste it as values, because otherwise whenever you will be changing the rows, changing the columns, or you will be using it elsewhere, then the results will be, or the data set will be changing. Okay, so that will be our data set, where log GDP in period T and log Maruti in period T plus 1. So let us now consider the correlation coefficient. So it is 0.92 once again. So you can always assume that the movements in the absolute stock prices of Maruti will be positively related to the movements in GDP, but you can recheck these also using the proportionate changes. Okay, so this perhaps showing us that Maruti may be a cyclical stock. So now we move on to the other data or the financial ratios. Now, I'll not be going into those things. For example, you can always do these things. You can take the basic EPS, you can plot that. So that will be giving you some line, and on the basis of that line, you can find out something. But I'll show you one thing. Whenever, because I have seen that among many of the students, that whenever some trend line is fitted to the diagram or to the data set, they just go for the linear trend. But often the linear trend is not the best possible alternative for that data set. So before you go for the trend determination, be very specific about the nature of the data set or nature of the trend. So let us consider this. I'll be just showing you. So let us first of all consider this basic EPS. Okay, so that is there actually. I was working with that. So this is our EPS. First you plot the data as a line. So that's your EPS. But please do not feed a linear trend to this. So how do you feed a linear trend? Or rather, how do you feed a trend? There are so many trend line options. So if you are doing it for the first time, now see, there are many different options. Okay, so you have exponential, linear, logarithmic, polynomial of order 2 to 6. You can have power, you can have moving average. So, and for the moving average also, you will have to specify the period. So this was the thing that I was trying to point out when I was talking about the frequency bandpass filter, because then you will have to specify the lag of the period, right? Okay, so in every case, how to choose from among the different trend line options? You can always choose one, say exponential, and there you will be finding out that there is an option, display R squared value on chart. So if you click it, then you just see the R squared value will be given here. And as you all know, higher the R squared value, it is better. So you can actually go for different options and you can write down the R square values in each and every case. Therefore, in that case, you will be choosing that trend line which will be giving you the highest R square. Now, suppose I am talking about the polynomial of order 6. You just see the value of R square. So this is 0.98. So probably actually whenever you are talking about any financial variable, then polynomial of order 6 will be giving you a very or rather, what should I say? It will be giving you a very accurate trend line. So here also you can go for the polynomial of order 6. Okay, and I'm just changing the color of the line to make it more visible. So it's 2 point. So that is the, and I'm just changing this line. I'm making it black. Okay, so that's my EPS. And that's the linear trend. That's my EPS and that's the linear trend. Okay. So you can always compare this linear trend with the others. Now, I have already shown you the frequency band pass filter. So you can use this frequency band pass filter to compare the cycle of EPS with the cycle of the others also, other indicators also. For example, say, suppose you are talking about the efficiency criteria, right? So efficiency criteria. And suppose I am trying to relate the efficiency with profitability. Profitability criteria. So what is your research question then? If you call it a research, then what should be your research question? Then if a firm is efficient, then will it be profitable? So if a firm is efficient, will it be profitable? What else? If a firm is, I'll be showing you one particular question and you can use it in many different ways. If a firm is efficient in period T, then will it be profitable in period T plus 1? So these two are very pertinent questions. So if a firm is efficient in Tth period, will it be profitable in the Tth period? And if a firm is efficient in period T, then will it be profitable in period T plus 1? Now just tell me which indicators I'll be taking. So I'll be choosing one efficiency indicator and one profitability indicator of your choice. So give me the choice. Don't write anything in the chat box because I can't see that. So it's your choice. I'll be doing on the basis of that. Just tell me, who is going to say first of all, what is the efficiency indicator I'll be taking? If you could recall what are the efficiency indicator. Who is going to tell? It's already 4:20. Any efficiency indicator? Am I audible?
Inventory turnover.
Okay, let's see whether that is here or not.
Yes, ma'am, it's there.
Inventory turnover. Yes, it's there. Okay, so I'm taking inventory turnover then. Okay, then just tell me any other profitability indicator. Gross profit margin? Gross profit margin? Happy with that?
Yes, ma'am.
Where is the gross profit margin? Where is the gross profit margin? Tell me from this data set, from where do you locate gross profit margin? Just don't switch over to return on asset. Where lies the gross profit margin?
PBIT margin.
PB?
PBIT margin.
Profit before interest and taxes.
Yes,
Okay.
Column 14.
What's the problem? I can't hear you. PBDIT. So should I take this one? This one.
No, ma'am, PBIT margin.
PBIT margin, because this is the profit before depreciation, interest and taxes. And this is, you have subtracted the depreciation. So this is the profit before interest and taxes. Okay, so this is actually your EBIT.
Yes, ma'am.
You can this.
Gross profit does not deduct money, it's before deducting depreciation.
Gross profit margin is defined as EBIT in terms of EBIT, right? So you can use, now see, there are different indicators here, you can find out that there is a substantial difference between these two values, right? So that means depreciation is very significant for this particular firm. So I'll rather suggest you, when you are doing some research work, then you can consider different profitability ratios and you can check whether your results will be holding or not. I'm just saying you one particular issue. Now just tell me on which you are interested to settle, on PBIT margin, on this one that I have colored, or I'll be going for this. Just tell me. Okay, I'm going for this one. PBIT margin. Okay. Okay. So efficiency and gross profit. Efficiency and profitability. Okay. It would have been better if we talked about in terms of net profit margin. Okay, then what we shall be doing? So let us first consider the net profit margin, PBIT margin and the so that is our PBIT margin, and then we shall be considering the inventory turnover. Now in that case, you may not get any relationship. Choice of the indicator may be very, very crucial. Okay, let's see what result do we get from here. Okay. And the debt. Now what shall I do? I'll be first talking in terms of the turnover ratio. I'm writing it as ITR, otherwise EVUs will not be taking this name. Okay, so ITR and PBIT. So let's first go for this correlation thing. What's the correlation between ITR and PBIT? So what is your idea? How do you interpret the result? Efficiency and profitability indicators are inversely related. The firm may be efficient, but it may not be profitable. So let's see what happens if you lag it by one period. So if a firm is efficient in period T, then will it be profitable in period T plus 1? So now the correlation will be between, so efficiency from period T array 2 efficiency in period T plus 1. So it becomes more negative. So if you are managing your inventory in a very good way in period T, then that is not being reflected in your profitability, right? So efficiency is not being reflected in the profitability. So what about the cycles? Let's consider the cycle. I'm working with the original series, right? I'm not taking the log, but you can always take the log. So 5 to 20. No, I have to close this one. No, 5 So annual start date 2004 and the end date 2020. Okay. So I'm going very fast. So frequency filter. I'll have to check for efficiency. Unit troop testing first of all. I1. IPR is I1. Both are I1. But please don't go for co-integration checking. Both are I1. Those who are familiar with co-integration checking, please don't go for co-integration checking because you have only 17 observations. This is IPR cycle. I1. So that's my cycle. PBIT. So let's see. Cycle PBIT and ITR cycle. We're opening these two as group. So review it. Okay, so is there any relationship? Is there any relationship? What do you feel? In this zone, actually, these two were moving in the opposite direction. Here, that was actually the crisis period. Crisis period means the period of global financial meltdown. Then PBIT was falling as well as EPS was, that is not EPS, that is ITR. So profit before interest and tax was falling and this was also falling. Here you have more or less a positive relationship. Okay. But just by looking at that, what is your idea? Are these two related? Now I am asking for your opinion because my opinion may be different from your opinion. I'm just showing you the method. You will have to interpret it. Now this is just T and T. It is not T and T plus 1. What do you feel? Are the cycles related that much? I don't think so because the fluctuations are not similar, because there are phases when the PBIT was fluctuating relatively less and ITR was fluctuating by relatively a greater amount. So just on the basis of this, it is very difficult to say. Yeah. Yes.
I'm just a request.
Yeah.
Can we once check with EBDIT?
Okay.
Can we just once check with EBDIT?
That is also permissible. So that is the thing, because in some cases you may not get the same, you may not get a desired result just because of the fact that you have not chosen the right indicators, right? So inventory turnover ratio as an efficiency indicator may not be related to the profitability indicator. So that is why I have asked you to choose the indicator. So if you choose two wrong indicators and if you say that, okay, there is no relationship, then possibly you have made some mistake right from the very beginning, right? Okay, so let us go by this suggestion. What is that? What you are trying to use? Just tell me.
EBITDA, that is earnings before depreciation, interest, tax, and amortization.
Is that available here? Let me see.
It's available. EBITDA is available, ma'am.
It's available. So
Row
let's
14.
yeah. So let's go by the PBDIT. Okay. So let's consider PBDIT then. And who is answering? And who is for whose suggestion is this?
This is part.
Okay. But yes. Okay, so it's PBDIT. So, so let's go for the cycle. This is PBDIT. So PBDIT cycle and ITR cycle. Now just tell me, does it improve? So it's your suggestion. Just tell me, does it improve? Personally, I feel no. But that's my opinion. Because there are areas where these two are not moving in the same fashion. So probably efficiency is not being translated into profitability. You can do the same thing using many different indicators. So one important thing that you can do at home is perceived profit opportunity translated into higher actual profit. How do you show that? You can take the retained earning ratio or retained earning itself. Retained earning will be too large a value. You will have to take the log. So retention ratio and net profit margin, right? But here, in order to get, so just check if retention ratio in period T is related to NPM in period T plus 1. Instead of NPM, you can take any other indicator also, any other indicator of profitability also, right? So here, the lag is very, very important, because if you retain something in this year, your profitability may not increase in this year also. So you will have to consider the NPM in the period T plus 1 then. Okay, now you can calculate the correlation coefficient between the cycles also. In that case, you can see how the cycles move. So when you just eliminate the trend, how do the two cycles move? Whether they move in tandem or whether the correlation coefficient is not that significant. So that is also permissible. Okay. Now, should we go for the, okay. So one important thing here. See, this is the earning yield. So this was the thing that someone was talking about in the last session. So if price earning ratio is given as price by earning, then what happens to earning by price? So it is nothing but the earning yield. So from here, I have calculated the price earning ratio. So the price earning ratio, see, this is quite high, right? Of course, here it is crossing the benchmark of 1929-30 also, it is more than 33. But here for the Maruti Suzuki, actually the price earning ratio is quite high. Now for that, how do you justify this higher price earning ratio, or can you justify this higher price earning ratio? For that, you can consider the sustainable growth rate also for the firm. So how could you find out the sustainable growth rate? The sustainable growth rate is retention ratio times ROE. Retention ratio times ROE. Okay, so so what is ROE? How do we find out the value of ROE? Because in the financial ratio, we don't have the return on equity. Do we have? Here the return on equity is not presented. So we shall have to calculate it from where? Balance sheet or profit and loss account. Tell me. What is ROE? It's return on equity, but how do you find out ROE? Who is going to answer?
Profit after tax divided by net worth.
Profit after tax divided by net worth.
Net worth.
What is net worth? Common stockholders
Is
equity, right?
total equity, equity plus reserve.
Common stockholders equity, right?
Yes.
Yeah. So net profit and the total equity. So from here, first of all, consider the net profit. This is the profit and loss account. This is profit and loss before tax. Profit and loss for the period. So that is, now I have data for only 5 years. So I'm just considering the sustainable growth rate for the 5 years. So this is my this is my PAT and equity, total equity. Total shareholders fund. Okay, then return on equity is equal to profit after tax by total equity. That is return on equity. That is my retention ratio. And we have this in the reverse way. What are the retention ratios? Retention ratios, the last 5, right? Last 5. Return on equity times retention ratio. Okay, so this is my sustainable growth rate. Or this is the sustainable growth rate of Maruti Suzuki. What is your idea about the sustainable growth rate? It has fallen, right? In 2016, it was 10%. Then it increased slightly. Now it has once again fallen to 10%. Now, what is your idea? Sustainable growth rate of 10%. Is it very good or is it not that good? That's a tricky question. Answer is very simple. Is it good or is it bad? Come on, who is going to answer the question? Is it good or is it bad?
Ma'am, we'll have to compare it with something else.
Who is answering?
Ma'am, Priyanka.
Very good. Very good. So a growth rate of 10%, whether it is good or bad, will depend on the growth rate of its peers, right? So for that, actually, I have chosen Maruti Suzuki because I have, before I have prepared for this class, I have considered some other automobile stocks also, and I have found that over the time, Maruti has been one of the best performing firms in the industry. As such, the automobile industry is doing good because the projections are very good for that. But Maruti is one of the good firms doing very good in the sector. So the sustainable growth rate of 10%, 14%, whether these are good or bad, in order to comment on that, you will have to compare the growth rate with its peer. Now see, if the growth rate, so from here you can get one significant indication that the growth rate has fallen from 2019 to 2020, and it has fallen by 4%, right? So from 14% it has fallen to 10%. So so that might be some point of caution. So in the same way, you can find out the internal growth rate also, and the way that I have shown you, you can identify different questions and you can relate many different indicators in that way, right? So now my point was the price earning ratio was quite high for the Maruti Suzuki. Price earning ratios were quite high, and the sustainable growth rate. Now see, this is for, okay, this is for 2004 and 5. So let's go for, okay. Now say the price earning ratio has fallen from 33 to 25 in 2019, and in 2020 it has remained unchanged in 25. But if you consider the sustainable growth rate as we have calculated here, the growth rate has fallen, right? From 18 to 19, growth rate has fallen only from 13%. Sorry, growth rate has actually increased from 13 to 14%. But what happened to the price earning ratio from 18 to 19? It has fallen. The growth rate has increased, but the price earning ratio has fallen. And here, the growth rate has fallen from 2019 to 2020, but the price earning ratio is remaining unchanged. So can you at least you have some fear or some skepticism about the relationship between the sustainable growth rate and the price earning ratio. So possibly you cannot explain this high price earning ratio with the sustainable growth rate. So possibly there are certain other channels, right? So that is one of the very important observations about the farm. Okay. Now from here actually, and you just see another thing. If you consider the retention ratios, then see that was the period 2004-2005. The retention ratio was quite high during these periods of time. This is 4, 5, 6, 7, 8, 9, 10. So period 2008, 2009. So those were the periods of crisis, and the retention ratio was quite high. But see, in the recent years, the retention ratio has fallen, right? So the retention ratio has fallen. So perhaps that may be a reason for the reduction in the sustainable growth rate. Okay, so it is because of the dividend policy, perhaps. So you will have to link all these channels. Now, I'll be showing you another thing, because I'm yet to go to the prices. I'll be showing you another thing where you can comment on the most probable values of a particular variable. Suppose I'm talking about ITR. Now this is very simple. ITR, I'm showing you very simple methodologies. ITR. Go to the graph. Go to the graph and go to the distribution. In this distribution, you just go for the empirical survivor graph. I'm just describing it how. What does it mean? The empirical survivor graph. This empirical survivor graph shows the probabilities on this axis and the values of the variable in this axis. So you just take any point on this graph. So suppose we are assuming that the ITR value is 20. So corresponding to that, you have a value which is more or less 0.7. So the graph means that the probability of getting 20 or more is 70%. So in 70% cases, you will be getting an ITR with value 20. So in only 30% cases, ITR will be less than 20. So if you consider, say, the 20% value, then what is that? It's like 25. Okay. So to get a value of 25 or more is only 20%. So you can explain it in this way. You can get a value of 20 or more with 75% probability, but you can get a value which is 25 or more with only 20% probability, right? So that is how you can find out the most probable values of a given variable. So you can always compare these most probable values. So you can have different indicators and you can always go for the different values, right? So this is one way of, a very simple way to look at the different ratios. Now, so if you now consider whether the prices, so in our earlier sessions, we were talking about the bubbles, the formation of the bubbles. So how could you test for the presence of a bubble using this data set? Now, as I have told you, you have only 16 data points, so it is very difficult to go for the very difficult to go for any time series analysis. So always you can go for a panel data where you will be having the cross section as well as the time series, right? Now, what should be your model? Now, for the bubble, you are trying to find out whether the prices will be determined by the fundamentals. So you just consider the prices, annual prices or quarterly prices, whatever, and then you just collect data on different fundamentals. So you can have different areas, and from each area you can select one particular value of the one particular indicator, and you can consider the fundamental. But you should take into account one thing, that these fundamentals may be related among themselves. So there may be certain problems, so that instead of going for a simple panel, you may move on to a dynamic panel. Okay, so that might be some way out to tackle the issue of this multicollinearity. Now, so if the prices are determined by the fundamentals, then there is no question of generating the bubble. So prices are determined by the fundamentals. But if prices are not determined by the fundamentals, then there is a possibility that the bubble may be generated in the market. Right? Now, in that case, we shall be checking for another type of bubble also. So this is sheer speculation. Prices are not reflecting the fundamentals. But suppose that prices are reflecting the fundamentals, but will you be then happy with the situation? Now, care should be taken, because we have already exercised that for the green stocks. We have made some analysis on the green stocks, where we have seen that prices may be determined by the fundamentals. In most of the cases, prices will be determined by the dividend per share. So that is what the dividend discounting model is showing you. So prices may be determined by the DPS. Now, there may be a case, say there is a certain portion or the residual which is not determined by the fundamentals. Right? Suppose 80% is explained by the prices, explained by the DPS, say, and the remaining 20% is not explained by the DPS. And what happens to this residual? Now, it was pointed out that this residual is often dependent on DPS. So, as the fundamental, or we should not mention DPS here, rather it is fundamental. So the thing is, the residual is dependent on the fundamental. As the fundamental changes, the residual will be keeping on changing. Or if the relationship is positive, if you just increase the fundamental, then the residuals will also be increased. So what is the residual? It is the unexplained part. Okay. Now this problem is called the problem of intrinsic bubble. So this is more dangerous, because apparently there is no problem in the market. But the thing is that what is unexplained, what remains unexplained, will be explained by fundamental or any other fundamental. In our case, it was just the greenness of the farm. Now, the problem is, how do you cope, or rather, how do you see that problem? So as the fundamental improves, or the important variable that you are depending on improves, the unexplained portion will be also getting magnified. So the problem may not be visible on the surface, but the problem will be there. So using these financial ratios, this type of analysis of intrinsic bubble may be done, of course. In literature, the prices are made dependent on the DPS, and the intrinsic bubble is in terms of the residual and DPS. But you can always think about different fundamentals and then whether the prices are determined by the fundamentals or not. Okay, so that is one of the most important applications. Okay, so today I'll be taking a few more time, say 10 minutes or like that, because I have two more things to share with you. Okay, so okay, so let's move on to, I'll show you the okay. So, no, in fact, is this visible? Is this Word file visible?
Yes, ma'am.
Okay, okay. So, you can find out using these ratios the probability of default of a particular firm. Now, this was introduced by Altman. Now, during 2007-2008 crisis, there was a huge literature, or there was a huge debate saying that, okay, we cannot use the Altman Z-score because it is not predicting the bankruptcy or the financial distress. But later on, it was found that the prediction of the Altman Z-score model turned out to be quite true. So you can use this Altman Z-score model to use the or to calculate the financial distress of the firms, or the probability of default. So there is an indicator that you can calculate on the basis of the financial ratios, and depending on the value of the ratios, you can see whether the particular institution, particular firm will be in distress in the coming 1 or 2 years. Okay, so there are two versions of this model. One is for a non-manufacturer and the other is for a manufacturing firm. So if you go by only this formula for the manufacturing firm, then for the banking sector, it will be very difficult to use the Altman Z-score. So similarly for the non-manufacturers, so Altman introduced two types of formula for the Z-score. So what are the, now this Z-score is based on, the computation of Z-score is based on the MDA, discriminatory analysis. So for that is a different exercise. So from that, actually, these coefficients are estimated. Now, what happens in that model? We take two groups and we just try to find out what are the factors that discriminates one group from other. So what are the factors that will be differentiating one group from the other? So using that model, Altman provided us with the coefficients of these values. Now, of course, you may always question that why should we use these values, because that was based on some particular data set. So if we go for the other particular data set, so it may be different. Okay, of course, then you can always go for any MDA and you can find out two types of groups. So one may be bankrupted and the other may be the firms with sound financial health, and then you can go for search or exploration of the factors which will be making the difference between these two. Okay, so for a private manufacturing firm, Altman considered 5 indicators. Now, you can always find out these indicators from the financial ratios, right? So, there are 5 different areas and that could be easily done in Excel. So, the first one is the working capital by total asset. Working capital is the net working capital. So, liquidity, retained earning by total asset, the second area. Third area is earning before interest and taxes by total assets. So it gives you the profitability, equity, and total liability. So that gives you the leverage. and sales by total assets. So some sort of asset turnover ratios. So these are the different health areas. So you can take the values. I'll not be showing those things with you because I'll be giving in the assignment, actually I'll be requiring you to calculate the Z score and another thing that I'll be discussing right now. Okay, so you can always calculate for a particular period, you can calculate the Z score. So you just find out the value of T1, T2, T3, T4 and T5. Then use this formula and you just plot, you just put the values of T1, T2, T3 here and you get the value of Z score. Then there are these values which defines the zones, the distress, gray and the safe zone, right? So just by looking at that, for each year, you can find out the probability for, say, Maruti, in this case, the probability of going into distress in coming 1 or 2 years. In some literature, it is stated that in coming 1 year, and in some literature, it is pointed out that in coming 2 years, right? And for a private non-manufacturer, you don't have this T5 because the sales by total asset, since it's a private non-manufacturer, the sales by total asset will no longer be relevant for the firm. So that is why we don't have T5. And since you have lesser number of coefficients, here the coefficient values has also changed. Now, here often it is taken as, here it is taken as 0.998, in some cases it is taken as 1. So these coefficients will be varying minutely from one literature to another, but roughly they are the same. Okay, so you can always calculate these probability of default. So along with all those financial ratios analysis, so you can make your project more interesting by predicting the probability of default, right? Now, you can also, let's see where the price data is. Okay, so that is the price data for Maruti that I have taken from the bseindia.com site. So there are different prices, number of trades, total turnover, percentage delivery quantity to the traded quantity. This actually is relevant for the traders in the market, because that gives us the bullishness in the market. So along with the prices, this percentage delivery quantity to traded quantity is also considered, right? Now, on the basis of these prices, you can actually find out many different indicators. Now, that is once again not a part of the financial ratio, but I'll be showing you one particular way to find out whether the market is in stress or not. Because here our analysis is not essentially dependent on the prices, right? So we are talking about financial ratios, then along with those financial ratios, we are coming to the prices. So here we shall be introducing one important concept, which is the concept of market stress. Now, see, volatility is definitely a bad thing, but not all volatility is that bad. Because what is bad is definitely a stress. So how do you define a stress then? So let's consider that very briefly. So we consider the return, which is nothing but the proportionate change in the prices. So the proportionate change in the prices, that's the return. And since it's daily data from 2004, I have 4155 data points, right? So that is quite sufficient. So just I'm just pasting the values. Yes. Any question? Someone has unmuted. Do you have any question? Okay. So that is the return series, and we are trying to find out the stress. So that we shall be sharing a very simple way of considering the stress, which is available in the literature. This is called Cmax. It's called Cmax, right? So how do you find out the Cmax? In the context of Cmax, we first choose a window of past returns, right? A window in the past. So we shall be considering, say, a 365 days window, right? So when we are thinking in terms of today's price, we shall be basically talking about in terms of the price which is 365 days back. So that is what is meant by a window of past. Now, why it should be 365 days? Because the policies, macro policies, monetary policies, different other policies also will be changing annually. So if you take the data to be window to be less than 365, it will be too short, and if it is taken to be more than 365 days, then the fluctuations will also be not considered, so that will be too long. So the literature suggests that this is ideal. So here we are following the methodology of Sarkar and Patel. So what they do is that we take the 365-day window and then we calculate a rolling maximum return for this 365 day, right? So what is the idea then? So we start from then the 366th day, because on the 366th day only we have the first 365 days of return. So the max return for the 366th day is the max return of the 365 past days. Okay, so now we calculate the max. So first calculate the max, then I will be showing you the remaining methods. So I'm going to the 366th observation. Here it should be 367th. Why? Because it is actually this is actually the 366th observation. So max of what? That is B1 to B366. That's our max return. So we do the same exercise. So for the second day, what is that? It is the max of, so we just consider the next 365 days. So it is just like the rolling SD or something like that. So it is a rolling max return. So in that way, we have calculated the now. So in some cases, the returns are remaining. Yes.
Maybe B2 rather than B1.
And then B1, no? It should be B2.
B2.
Just wait for a second. It should be B2, right? Thank you for pointing out. It should be B2. The result will not change, of course, but that is a mistake. Now you see, in some cases for a range, actually, the maximum return is remaining unchanged. Okay? So that may be the case because over a certain period of values or over a certain period of days, actually, say the prices will be, or the returns will be remaining unchanged. So now we have calculated the max return. Now for each day, we shall be comparing the return with that max return. Okay. So for say day T, we have one max return and we have one actual return. So we shall be expressing the return on that day with that max return. So for this particular day, this is the max and this is the actual return. So we calculate this return in proportion to the max, right? So this return in proportion to this max. So how do we compare a day's return with the 365 days max, past 365 days max return? So we shall be doing that. So that is one series. This series is called the Cmax series. Now what happens if this value is exactly equal to 1? Then in a particular day, the price or the return is exactly equal to the Cmax, so that there is no question of stress. So if the return in a particular day is less than the Cmax, less than the max, so that this ratio is less than 1, then what happens? Then the return in this particular period is less than the maximum that the market can give you, so that it is stressed. It may be stressed. So we are yet to define the actual measure of stress. So that is how the Cmax is interpreted. Now suppose it is greater than 1. So in that case, the return in a particular day is greater than the Cmax. Therefore, on that particular day, the market is giving you more than the historical average. Okay. Now we have the Cmax. So on the basis of the Cmax, then we shall be trying to analyze whether the market is in stress or not. Now here by market, I mean the Maruti Suzuki, right? So you may later on compare with some other market or some of its peers or something like that. Okay, so suppose your return at one particular day just falls below the 365 days historical return. Now, will you be calling it a stress? The literature says that you should allow a band, right? So, before, suppose you have a benchmark, and if your return falls below that benchmark, will you be calling it a stress? So then you will be too pessimistic, right? So if that falls below a certain band, then it is actually stress. And if it falls and if it lies within that range, then it is not that stressed. Similarly, you can define a band on the upper side also. So if your value just moves beyond that band, then are you stressed? No, that is the irrational exuberance. So that exuberance or optimism and pessimism is natural if you are lying within this band. So it is like that. So like this, suppose that is your benchmark, this is your benchmark, and so you shall be defining some upper limit and some lower limit. So this is your, say, upper limit, and this is your upper limit, and you can have your lower limit also. This is your benchmark. So if you are in this range, then you are optimist. But if you cross this, then you are facing, or you are having irrational exuberance. Similarly, if you are here, then you are not stressed. Prices, returns have fallen, but that is not a stress. You are stressed only if your return falls somewhere here. Now, how to define these two ranges? These ranges are defined in terms of the standard deviation of return. Right? So this is defined in terms of the standard deviation of the return. So if your return on a particular day is less than, say, or rather max, I'll not be talking in terms of Cmax, max minus 1.5 SD of return, then possibly you are stressed. So your return is less than max, no doubt. But what is the range? So you are defining a range which is defined by 1.5 SD of the return. Similarly, if your return is greater than max plus 1.5 SD of the return, then of course you will be having irrational exuberance, right? So since we are talking in terms of stress, then this formula is really very helpful for us. So either you take the decision on the basis of the Cmax, so whether Cmax is greater than 1 or less than 1, or you can find out the ranges and you can define return in terms of max plus minus certain SD. Now you may raise a question why we are using this 1.5 SD. In literature, instead of having 1.5 SD, you can have twice SD also. But in that case, if you just extend your band, then you are making, or rather, you are actually making some understatement about the market's position. And if you are making your range shorter, instead of having 1.5 SD, if you make it 1 SD, then you are making the range shorter, the band shorter, so that you will be more pessimistic about the market. So the literature suggests that it is better to take it as 1.5 SD. So for that, how could you find out? So when the return is less than max minus 1.5 SD, then it is stressed, and if it is not, then it is not stressed. So very quickly, let's move on to that. Therefore, I'm just deleting this Cmax method, Cmax column, and first of all, I'll be calculating the standard deviation for the entire return series. Now it should be based on the entire return series, right? It is not based on the 365-day rolling average or something like that. It is not that. So that is our SD. Okay, so this is our SD. So what we shall have to find out? We shall have to find out the, okay, let's hide these values. I'm just hiding these values. Or rather, I can also delete those values. So we have only the relevant portion. So we have the max. So now we shall have to calculate max minus 1.5 cross SD. So what is that? This is equal to max minus 1.5 into our given SD. Now this has to be constant. So therefore, we just put dollar signs here. So that is constant. So put a dollar sign here. Okay. So that is our max 1.5 SD series. So whether stress or not, so then what should be our idea? If this is less than this, then the market is stressed, we call it 1, or otherwise it's 0. Okay, so that is the formula. Sorry. If our return is less than max minus 1.5 SD, then it is stressed. We denote stress by 1, or otherwise it's 0. So it's stressed actually. So that is how we get the period of stress and the period of no stress, right? Okay. So So in that way, you can find out the stress series. So you can call it the series of stress. Okay. Now for this entire period, it may be stressed for since you have considered the 365-day average, or you may have 0101 in that way. So that is the stress series. So you can work with that, you can plot that, and you can identify the zones where the system is, where the series is stressed, where the market is stressed. You can compare the two stress series also, and then you can just plot the stress series and then find out what happens to the fundamentals then, because that is giving you the entire stress series. But of course, you cannot find out the stress series with the annual data, and for the quarterly data also it will be giving you very unnatural results. Okay, so this is one of the very simplistic way, instead of going for Markov switching or any other type of regime switching model. So you can find out the periods of stress and no stress, right? So these are some of the ways in order to how that shows how we can use the financial ratios to evaluate the firm health. Of course, there are many, but for that you must have some other large data set and many other companies. Okay, so for we shall be ending up here, but before I end and go for the once again go for the assignment thing, I'll just take 2 minutes from you to show a video, of course. So this shows that the first one shows you the need to have some idea about how to invest, and this rather shows the what happens if you do not take the wise decision. Now just tell me, is this visible? Is this screen visible to you?
Yes, ma'am.
Okay. So how about okay, so that probably explains, that's self-explanatory. So with that, we have come to the end of our session. So there are, of course, lots of many other things to do. So perhaps we may meet later on once again for other workshops also, where we may actually concentrate more on the prices rather than on the financial ratios. Okay. So so far as the assignment goes, I'll be sharing a data set with all of you. Actually, all of you means those who have done the sessions for all the 4 days. Actually, I'll be sending the data set to all of you. Of course, Professor Indrajit Ray will be excused from submitting the assignment, but otherwise all the other participants will be, because it's your money. So if you want to lose it, you can lose it in one day. So the others will be submitting the assignment. So I'll be giving you the reference, of course. So if you are interested, okay, I'll be sending you a mail this evening, so that I'll be giving you the references also, and I'll be sharing the assignment with you. So how much time do you require? 2 days? 2 days perhaps? So you will be submitting the assignment, and once after the submission of the assignments, we shall be distributing the certificates. Okay, so thank you all for joining. So possibly we shall be meeting once again in some other workshops. And if you have any kind of queries or any kind of in future, if you have any kind of requirement to communicate with me, I will always be available over mail. So just drop a mail to me. Okay, so if there is a question. Okay, Partho Sharathi has already raised a question. Is Maruti a lead indicator of GDP business cycle? Partho Sharathi, this is just by using this data, I cannot comment on that. For that, I'll have to have more data, right? Okay, so got the answer. Showdish also 1.5. Okay. Okay, so thank you so much for joining, and possibly we shall be meeting at any point of time. Yeah.
This lead and lag variable, is your own variable lag or some other variable lag?
In context of what?
In any variable, just like the Maruti and GDP, so lead or lag variable, own lag or other variable lead or lag?
In both the cases, suppose you are talking about GDP and the other variables, right? So either you lag GDP, so that depends on the underlying theory. If you feel that the stock prices will be following the GDP, the real economic activity, then you will have to consider GDP T and stock T plus 1. But the alternate, but I would rather suggest that you should test the alternative also, the stock price in T and GDP in T plus 1. So in that case, you will be able to find out the lead lag relationship. Now, this is the very, very simple and naive way to find out the lead lag relationship, because there are so many complicated models that you can use. For example, you can go for panel bar, and there are so many other models, the impulse response functions. So that will be giving you some idea about the lead lag relationships. Okay. So right now, if you have only this much of data, then on the basis of that, you can use the correlation. So first take xt yt plus 1, and then take x yt and xt plus 1. Okay. Does that clarify? Okay. Okay. So if we don't have any other questions or clarifications to be made, so let's leave for today now. Okay. So that's the end of the session. Okay, so bye everyone.
Thank you, ma'am.
Thank you.
Thank you, ma'am.